Okay, sorry for the delay. Welcome to the March 21st edition of the Fats, Fuels, and Oils webinar. This week we are going to cover, we'll talk a little bit about distillers corn oil, and then we'll talk about the EMTS data and talk about what's going on with biofuel margins, and then the implications of the NOPA soybean crush report last week. So let's get into it. All right. So actually, let me just go back a slide. Sorry, let me talk about DCO, because I didn't really, unfortunately, I ran out of time before I could put some DCO slides together. So DCO production in February was basically in line with where it was the prior month. We're predicting DCO production slides a little bit for the year, despite the fact that we actually have raised the yield for our DCO recovery from ethanol production. So for the last 5 years, we've been using 0.8 pounds per gallon of production, and based on conversations with people in the industry, that number probably is pretty good, but there also is there are ways to increase the yield, and there could be ultimately a substantial increase in yield. And so about a year ago or so, we decided to kind of gradually increase our yield. The main reason for the steady to slightly down DCO production, despite the fact that I think, as you can see here, our forecast for ethanol production is up modestly versus last year, is that at least so far, if you look at kind of the breakdown of the feedstocks used in ethanol production, what you've seen is a rise in some of the other feedstocks rather than corn. So sorghum is typically the most commonly used feedstock outside of corn, but then there are some other feedstocks that are used, and those have increased a little bit as well as sorghum. And so our corn grind is actually down a little bit, and I think the percentage of the corn grind that's dry mill, which is actually what produces DCO, actually rose a little bit, but the overall decline in the corn grind has taken is kept our DCO production essentially steady, again, despite the fact that we raised our yield from 0.8 to 0.816 effectively. We'll see how this works out in terms of production and what it implies for the demand side, since we don't really get USDA numbers to reconcile to for distillers corn oil. So we estimate all of the numbers, and based on what like non-biofuel usage looks like and what biofuel demand looks like, and then the implications for ending stocks, we may adjust that a little bit, but the plan is to sort of slowly raise our yield over the coming years, and again, we'll kind of see how that works. So we also got EMTS data on Thursday for February, and as you can see here, based on the EMTS data, production of ethanol in February was effectively flat versus last year, after being above last year in January. And we've got ethanol production up a little bit year over year to 14.3 billion gallons, which is really essentially where we were last year. But we also have some growth built into our gasoline consumption, primarily because we assume that gasoline prices during the summer driving season will be lower than they were last year, and also because more people are, or more companies are requiring people to return to work. I have a friend that lives here, and they're just getting back to sort of saying that everybody within 50 miles of the office needs to come in 3 days a week. And I think that that's a trend that probably kind of continues throughout the rest of the year until we get to whatever the balance is between sort of everybody going to work all of the time before COVID and nobody going to work during COVID. But I still think that it means that that in the short term, gasoline consumption probably continues to grow a little bit, about maybe 2% a year. But obviously the adoption of electric vehicles has some implications for longer term gasoline demand. But at least in terms of 2023, what our assumption for ethanol production and gasoline consumption implies is effectively a 10.5% blend rate. Now that's not actually the blend rate. The blend rate turns out to be a little bit lower because we export some ethanol, and the number that we use to calculate the blend rate also includes exports. So we do that just because it's most of that stuff is on the same sheet, and I would have to hook up another sheet, which isn't that tough, but it just is the way that I've done it, essentially. So you can assume that the number is probably 0.2 or 0.3% lower than the number that we're using here. And that's down from 10.7% in 2022. The reason that ethanol is important for us beyond DCO production is the implied gap between ethanol production and the ethanol mandate. Now, it is important to note that the mandates, while the EPA announces volumetric mandates, so the EPA announces mandates that imply a 15 billion gallon ethanol mandate, that mandate actually, when it's translated from the national mandate to obligated parties, what they get is you'll blend a percentage of the fuel that you use or sell. And so what that turns the national volumetric mandate into is actually a percentage of consumption when you actually go to sort of reconcile the obligations at the end of the year. Still, we need a number to work with, and so we kind of use the national volumetric mandates for our forecasts, and understand that maybe that ultimately means that we're over forecasting a little bit, but it's one of those situations where we've done it consistently, and so even if the exact number isn't right, the trend in the numbers should be correct. I say all that to say that you can see in 2022, and then we're expecting again in 2023 for ethanol production to fall short of the ethanol mandate. Now, again, so the 949 million gallons that it falls short probably will be reduced by the time that you get down to the obligated party level. But this gives us sort of a number to work with and to understand where production has been, or we expect production to be this year versus where it has been in the past. And you can see in 2020, 2021, obviously a lot fewer people were driving, and so ethanol production exceeded the mandate. And last year and then this year, we expect it to fall below the mandate. Now, this has a couple of implications. The most obvious is, as we talked about a lot of times on this call, the spread between the D4 and the D6 RIN. Whenever the market is concerned about the ethanol blend wall. That is production not being able to reach the ethanol mandate. The spread between D4 and D6 narrows because people effectively produce a D4, sell the more valuable D4 RIN, and then buy a D6 RIN to meet the mandate to the extent that that's possible. Obviously, if you're an end user, you can't do that. But if you're a producer, you can, and that's what happens. The other implication from this is that in order to meet the total mandate, we need to, if there's a gap between ethanol production and the ethanol mandate, that additional D4 production needs to make up that gap. So that implies that there will be more biomass-based diesel production than the biomass-based diesel mandates suggest. Now, you have to adjust that 949 million gallon number by the number of RINs that biomass-based diesel gets relative to ethanol. So ethanol generates 1 RIN per gallon, biodiesel generates 1.5 RINs per gallon, and renewable diesel generates 1.7 RINs per gallon. So the way to adjust this is really look at the ratio between biodiesel and biomass-based diesel, and then calculate what that average RIN per gallon is. And it turns out, at least in our forecast, to be about 1.62, somewhere right in that area. And so you would take the 949 million gallons, and then you would divide that by 1.6 to get the actual number of gallons of biomass-based diesel that needs to be produced to fill that ethanol gap. Last month, we were predicting that the ethanol gap would be about 1.2 billion gallons for both 2023 and 2024. You can see it's come down about 165 million gallons for 2022, or for 2023 rather, and a little bit more than that for 2024. And there's 2 reasons for that. One, ethanol production is run a little bit higher than we expected. But the second is something that we'll talk about at the end of this presentation, which is there's a category of renewable diesel that we effectively were forecasting 0 production for. But over the last 3 or 4 months, production has really ramped up in that category, and it made me kind of look into it. And again, I'll explain all of that a little bit later. But because of that, in the way that I'm treating it, it also effectively reduces the amount of biomass-based diesel that will need to be produced in order to close that gap, or it does in theory, kind of, anyway. Okay, so on to biodiesel and renewable diesel. Production in February for both was down slightly from January. That's, again, not uncommon. You can see, although I guess the last couple of years it hasn't been, but February is typically, well, it's not typically, February is always a shorter month than January. And historically, January and February have both been sort of, there's a seasonal pattern that we've talked a lot about on this call, where production is lower in those months and then tends to be higher in the last couple of months of the year. So it's not a big surprise that that production was down a little bit. You also had the HOBO spread in February kind of rally pretty sharply through the first 20 days of the month, and then kind of come off at the end of the month. And the higher the HOBO spread goes, the less profitable it suggests. It's a very crude measure, but still, the lower it suggests biomass-based diesel profitability will be. I would say that at this point, that a HOBO spread probably reflects more of what's going on with renewable diesel than it is with biomass based or with biodiesel, not because there's more soybean oil used in renewable diesel, although I think volumetrically there probably is more soybean oil used in renewable diesel production. But just because what's been happening with the margins that we monitor. And so it seems to be tracking a little bit better with renewable diesel, at least recently, than with biodiesel. Going forward, we expect that production will increase. The big question, I think, really is not so much on the biodiesel side, because we've got biodiesel production down just a little bit, and so maybe biodiesel production will be a little bit stronger than we expect, but it's probably a little bit more on the renewable diesel side, and I don't think that that's a long-term effect. I think it's more of a short-term effect, or there's a learning curve with pre-treatment that seems to be catching some companies out. And so I think most companies, when they open up a renewable diesel facility, they order RBD or they buy RBD soybean oil and other feedstocks so that they have enough supplies to start up and get through this, the pre-treatment learning curve. But it seems like the pre-treatment learning curve, at least in recent months, has been a little bit steeper than some of the producers had anticipated. And that's part of the reason that we've seen the weakness in soybean oil prices, and feedstock prices more broadly. Obviously, some of it has been disappointment with the mandates, which I would argue doesn't necessarily need to occur. But also there is a short-term oversupply where there's this additional feedstock that kind of needs to get used up before prices can sort of stabilize and start to move higher. That argument is predicated on the idea that energy prices are going to remain close to where they are, or close to where they have been. And last week, obviously, crude oil fell more than it has in, I think, almost a decade, or at least that's when I looked back through the nearby futures. It looked to me like there was a week in 2014 that might have been a little bit larger, but beyond that, we haven't really seen a decline that big in crude oil in quite a while. And all of that is due in part to the concerns about the US and over the weekend European banking system, and whether the sharp rise in interest rates that the Fed has undertaken to fight inflation has really blown a hole in a lot of banks' balance sheets, because they bought bonds that had a lower coupon rate. And if you know about bonds, what you know is that as interest rates rise, the face value, or the price of the bond, the face value doesn't change, but the price of bond is inversely related to the interest rate. So as interest rates rise, your bond that pays 2% is worth a lot less than a bond that pays 6%. And that sort of marking to market of those bonds has made some depositors nervous. They've pulled their money from, most famously, Silicon Valley Bank, and the Fed had to take that over the weekend. Credit Suisse, who has had some problems for quite a while, got taken over by another bank whose name escapes me right now, but effectively they were bankrupt. And while Silicon Valley Bank was deemed systemically important, and all of the depositors' money, the government backstopped all of the depositors' money, it had some billions in assets. And Credit Suisse had $1.4 trillion in assets. the bank's assets were larger than the GDP of the country that its headquarters were in. So that's a big deal, and those things don't tend to happen in a vacuum, and they don't tend to solve themselves sort of overnight. And so there are concerns about the economy going forward. That's important not only for fuel prices, but it's also important more broadly for feedstock values, because as I've said before, soybean oil and these fats and greases aren't only used for biofuel production, but they are in so many products. They're in almost all of the stuff that you consume and that I consume. And so any weakness in the economy will probably have an impact on the non-biofuel use and will probably weigh on prices a little bit. All right, so our other gap that we monitor, and this is the more traditional gap. I've got to say, I didn't really start to consider the ethanol gap until the last couple of years. But the other gap that I have always sort of added back to my biomass-based diesel forecast is what I call the undifferentiated advanced gap. And it's basically the difference between the advanced mandate and production in the D5, D4, and D3 category. Now we add it back to biodiesel. So the way to think about it is really the advanced mandate less D5 and D3, and then whatever is left over that gets you your implied D4 biomass-based diesel mandate. At the edges, there's some things that make it a little bit more complex than that, but that's effectively the way that it works. And so for 2023, you can see we've got it up just a little bit, and then relatively stable over the course of the time that we actually have mandates from the EPA. Now we expect it to start to grow again based on our forecast for mandates further out, but that's mostly because we've got mandates growing, and then we've got electric vehicle adoption lowering ethanol production, and so that doesn't really do it. We've got the mandates growing probably more quickly than we've got D3 or D5. D5 is really kind of relatively steady and relatively small, and so I would say that it's probably more about the D5 than anything else, remaining steady while the total mandate grows. Relative to last month, the undifferentiated advanced mandate has come down just slightly for 2023, a little bit more for 2024. Those numbers are really minor compared to what you see on a monthly production basis and what the total undifferentiated advanced mandate is, or the way that we estimate the total undifferentiated advanced mandate. But it's another total that you need to add back to whatever the biomass-based diesel mandate is, to try and understand how much biomass-based diesel production there's actually going to be in any given year. So this one is one where you don't need to adjust it by the number of RINs generated. This is kind of a gallons for gallons mandate, effectively. All right, so I put this chart up. This is U.S. biodiesel exports according to the Census Bureau. And there's some disagreement between the Census Bureau and the EIA on what exports are. I chose to use the Census Bureau data because it's the one that I've tracked for the longest, and it should, in theory, capture biodiesel and renewable diesel exports. Whether that's really whether that's really the number or not, I think I wouldn't argue with anybody, and I wouldn't bet a lot of money that these are the actual numbers, but these are the numbers that the Census Bureau reports. And I put this up because I have this theory that if you take the mandates and then you run production through, and we've been through this before, that when you get to the implied capacity utilization for renewable diesel, that it turns out that that is a little bit lower than you would expect renewable diesel plants to operate. And so renewable diesel plants will need to operate at above a level implied by the mandates, which is why I think that the market's coming down, because of the mandates, while understandable, may have been the wrong move, at least in the short term. Now, it turned out that then we had oversupply, and so the market did know what it was doing. But I think that the recent decline doesn't mean that there has been a substantial change in the fair value price for soybean oil, because of this idea that feedstock demand is probably stronger than the feedstock demand that's implied by the mandates. One of the issues with this idea is that, taken to its extreme, you would absolutely blow up RIN values. And so while RIN values definitely track feedstock costs, and you can carry RINs over from one year to the next, and you can carry deficits over from one year to the next. And so the supply and demand, the impact of the supply and demand for RINs is a little diluted by that. But again, if you're going to, let's just say, and this isn't what I'm implying, but let's just say you're going to double the RIN bank. And so you take it from 3 billion to 6 billion or something like that, that's going to have an impact on prices. And as I've talked about this idea of overproduction with people, one of the questions that I've gotten is, what will this do to RIN prices, and will this have an impact on RIN prices? And what I've kind of said is the overproduction doesn't need to be that much. I think it's significant, but it's not necessarily enough to decouple RIN prices from feedstock costs. And there also is another outlet for that production that wouldn't have any impact on RIN prices, and that is exports. So you can export biodiesel or renewable diesel, and then the RIN gets separated and retired from the RIN bank, and it effectively has no impact on the supply and the demand of RINs. And so if you look at what has happened in exports over the last couple of years, you can see that it's grown really sharply in 2022, which, if we kind of go back to this slide, makes some sense, right? So 2022 is kind of a real number, and if that ethanol gap were there and it was filled by biomass-based diesel, we may have overproduced relative to the RIN, the RFS mandates, and as a result, exports may have become more attractive. I don't know if that's entirely holds up, but it matches up well with this big growth in exports anyway. And so we're predicting smaller growth in 2023 based on what we've seen through the first 2 months. But the amount that we are going to overproduce is, this slide probably should have come first. The amount that we're expecting that we overproduce relative to the mandate is 578 million gallons. And I guess if I look here, we didn't actually overproduce last year, so that blows that up. But if you assume that we're going to overproduce by 578 million gallons, but we're going to export 325 million gallons, then that really gives you 250 million gallons of biomass-based diesel production that would effectively add to the RIN bank, whatever the level of the RIN bank is. And so if it's 250 million gallons, you would multiply that by 1.6 to get the number of RINs, which would be, well, if it were 1.5, it would be 375 million gallons. So between 375 and 400 million additional RINs above and beyond the mandate after exports. The key here, I think, or part of the key here, and whether we actually get this 325 million gallon number, is the destinations. So Canada has been a big importer of US biofuel, and we've got them growing a little bit. I think there could be some question as to whether that will continue based on the beginning of the CFR later this year. Now, producers in Canada are already sort of, at least as I understand the program, are already sort of starting to produce against some obligations, and then their credits will kind of start to trade in September. That's kind of the way that I understand what's going on in Canada. So it may be that as that process goes through, even if the timing of that is a little bit off, as that process works its way through, Canadian demand for US biomass-based diesel isn't quite as strong as we're projecting here. And that would reduce it a little bit, or maybe more than a little bit, depending. The EU is another area where we've had small but pretty steady shipments. One of the things that I was talking with a colleague about yesterday is the sort of the different markets that producers could ship to, and the disparity between credit prices in the California market and the Oregon market, and why that persists. And there is there's obviously credits that are also available in Europe, and so that conversation kind of naturally led into, well, what do you think about Europe? Would people export more to Europe if we have the situation where we're going to overproduce? And in the end, it seems like it's probably the main reason that a lot of people ship to the California market and not to the Oregon market probably has a lot to do with logistics, and just that's where they're sort of set up to do business, and so that's why they do it. If somebody from a renewable diesel facility told me there was a different reason for the disparity, I wouldn't argue against it, but that's at least what I understand it to be, and kind of the way that I'm thinking about it. The sharp growth in other is probably the area where there's the most risk. So in the other category, you have Peru, and watched too much March Madness over the weekend. Sorry. So Peru, and they have been relatively steady around 25 million gallons a year. It's grown slowly, but steadily. And so that seems locked in, and doesn't look like it's that trend is going to change or is at substantial risk. Before, outside of Peru, and last year in particular, there were 77 million gallons that were shipped to Singapore, which doesn't make a lot of sense at all until I start to think about what we're going to talk about at the end here, and that what we're going to talk about at the end is kind of transformed the way that I've thought about some things, and this is one of them. So I've kept basically exports to Singapore unchanged although I think there's some substantial risk there, that could be lower. And so if Singapore doesn't import 77 million gallons of US, I assume, biodiesel or renewable diesel, then I think that that the export number obviously could be substantially lower, and then the impact on the RIN market could be more significant. So I say all that just to say that if it turns out that this theory is true, and I don't think we'll know conveniently for me, so I can keep talking about it, I don't think we'll know whether it's true or not until we get a little bit deeper into the year. But if it is true, then it's going to be important to monitor the trade flows for biomass-based diesel, not only in terms of the total volume, but also in terms of where those shipments are going. We talked a little bit about this. This is just the our expectation for D4 production versus our calculation of the mandate with the undifferentiated advanced and the ethanol gap in there. And then it also shows the production relative to the mandate. Now, in addition to kind of highlighting what I think is going to happen this year, I think it's also, and the reason that I'm showing so much history is because I think it's important to show that while the overproduction is significant, it's not unprecedented. And in fact, it would be a much smaller portion of the mandate in 2023 than it has been in prior years. And basically, the 2020, 2021, and 2022 years were kind of the outliers, where we underproduced relative to the mandates. And in 2023, we kind of get back to where we had been in the past. It's also important to remember that prior to 2020, small refinery exemptions had an impact on the mandates. Now, if you go back to 2015, small refinery exemption volumes were substantially smaller than they were in the following years, which is why you kind of see the calculated mandate drop down, especially in 18 and 19 relative to if you look at the actual volumetric mandates announced by the EPA, they continued to grow kind of year after year, but the small refinery exemptions then reduced the effective mandate down year over year. We don't have small refinery exemptions anymore, so we don't have to worry about that. But there's probably at least a portion of sort of that 700 million gallons in 2018 or the 863 million gallons in 2019 that are due at least a little bit to the fact that the mandate was reduced by small refinery exemptions. But again, in those situations, it was much more biodiesel at that point, but the producers run their plants at capacity utilization rates that make economic sense for the individual plant. And because of that, you can get this overproduction. So I think the bottom line on this theory that I've been talking about, and hopefully I won't talk about it that much more going forward a little bit until I finally feel like either it's been confirmed or it's been totally blown up, is that the overproduction that I expect, or the overproduction that's required to get back to utilization rates that are closer to the historical average, is not really that significant, and that it can be reduced by exports. And if exports are where we expect them to be, and there's some risk to that, then it may be that that the impact on the RIN bank is not really that significant in terms of getting production back to the capacity utilization rates that make sense. It will have a significant, it is significant, I think, for the feedstock markets, however, because if 578 million gallons is, if you call it 600 million gallons, then that is 44.2 billion pounds of feedstock demand. And so that is a significant volume of feedstock, additional feedstock up and over and above what is implied by the mandates, just if you just take the straight calculation. Again, the one part of that whole theory that makes me a little bit uncomfortable is that when I talk to people, it doesn't seem like there are people that are thinking something similar, but not in the same way that I'm thinking about it. And I don't know that that I have any special or enough insight to have figured something out that nobody else, or not nobody, but most people that I've talked to haven't figured out. I think that this is a situation where I would feel a little bit more comfortable about this idea if some other people felt sort of the same way, but we'll see. Okay, so the last thing that I want to talk about is this domestic renewable diesel production that generates 1.6 RINs. It's under the D4 fuel code, and it generates 1.6 RINs per gallon of production. And as you can see, basically this has been zero up until November. And then in December, January, and February, it really sort of exploded. And because it had been zero for so long, the way that I forecast it was just to say, it's going to be zero, and anything that shows up, I'm just going to subtract from someplace else. Pretty much, the numbers are small enough that they don't make a big difference in the overall scheme of things. However, when it really started to production started to rise, I dug into who actually qualifies for this specific RIN, which the EPA does not make super easy. And what it turns out is there are effectively 2 or maybe 3 facilities that qualify to generate this specific RIN. And what it is renewable diesel that is turned into sustainable aviation fuel. And so I'm not 100% sure why this process shows up as renewable diesel production instead of sustainable aviation fuel production. I think it has something to do with double counting the RINs based on some of the pathway approval letters that I read. That was kind of the gist of what I got out of it. And because of that, and because it's really sustainable aviation fuel, what I've done is, one, because this doesn't look like a situation where somebody is sort of opportunistically taking advantage of some favorable economics for a short period of time. Now, back here in 2021, that may have been the case, but now it looks like somebody has started up a plant and they're operating it, and we're going to do this going forward. So one of the big changes to my outlook has been the addition of basically 350 million gallons of sustainable aviation fuel in this category. And the difficult part about this is that the 2 facilities that qualify for this, one basically imports renewable diesel and then turns it into sustainable aviation fuel, and then the other, the process is all contained domestically, as far as I can tell. So the implication for feedstock demand is pretty substantial. If I just added 350 million gallons to renewable diesel production, then that implies all of that feedstock needs to come from someplace. If a portion of that 350 million gallons, or if we just go back and say a portion of the 29 million gallons that was produced in January comes from renewable diesel that was produced overseas and then imported into the US and then turned into sustainable aviation fuel, then in terms of the US balance sheets, that doesn't have any impact at all. And in fact, the impact is kind of negative because it's satisfying some of the D4 mandate without using any feedstock. So what I've done is I've added this, but then I've subtracted this category kind of out of my renewable diesel production. I think that's going to make some of my renewable diesel numbers look a little bit strange to people going forward, because my domestic total won't necessarily match the domestic total that's reported by the EPA, because I'm subtracting this out and adding it to sustainable aviation fuel. And my SAF numbers, when I start to show SAF production, which is a lot closer now that it looks like SAF production is multiples of what has been reported, will also be bigger than the numbers that the EPA reports every month. The bigger SAF production makes sense just based on anecdotal reports that we had heard from around the industry. If you look at the monthly totals that the EMTS reports, it's 1 million gallons or less. Maybe there's a month with 2 million gallons in there, but they're really relatively small. And this would, I think, change this changed the way that I viewed what's going on with SAF production. And like I said, what you'll see kind of going forward is more talk about SAF. One of the things that I've sort of been waiting on with SAF is for production to rise up enough that it became a significant source of feedstock demand, and then I would start to talk about it more and include it more in these presentations. Well, that happened overnight because I didn't know what was going on here, and I finally figured it out. I'm sure for a lot of you, you will have already known what was happening here, and will have already been thinking about it this way. But I'm just kind of catching up and getting up to speed. And so I just wanted to highlight this for two reasons. One, it's a big change in the way that we've thought about this particular category, and more broadly, what our renewable diesel forecasts need to be or look like. But also because it's a change in the way that those forecasts and the reported numbers will be. If you are sitting there and you're comparing your EMTS domestic renewable diesel production number to my EMTS domestic renewable diesel production number, they're not likely to match in the future, because this volume is getting subtracted out of renewable diesel production and added to SAF production. All right, the last thing that I want to do is kind of go through the gross margin stuff kind of quickly. So I finally published a report this week, and so the data has been getting updated, but I finally actually added some commentary. Whether that's a good thing or a bad thing, it's up to you, but I did finally I'm starting to get caught up from my problems with the computer. All right, So I've had a couple of weeks to kind of work through this idea that that biodiesel production is, or biodiesel margins, at least in the California market, have come off and could come off over the course of the rest of the year. And where I ended up is essentially with what you see. The first week that I showed this, we had a pretty steep line that went straight down to zero, bumped around zero a little bit, and then maybe went up a little bit after that. Now, like I said, I wanted to make that line a little bit, I want to make the slope of that line a little bit more shallow. And I've done that without really having to make changes that were artificial just to accomplish this goal, which makes me happy. So this is a forecast that I think makes sense based on at least conditions today. The main driver of this, I will say, is this shift back from a situation in the California market where biodiesel was trading at a premium over renewable diesel, and that premium has started to fade a little bit, and we kind of have it fading slowly over the course of the rest of the year. That means that in a time where energy prices and biodiesel and renewable diesel prices are kind of falling, that biodiesel is going to fall a little bit more quickly than renewable diesel. And if you assume that feedstock prices are generally all kind of trending the same, I know that's not exactly true, but if you assume that, then it really just leaves that change in energy prices to drive the difference in the margins and why you see biodiesel going down versus renewable diesel kind of steady. There still is this idea that that renewable diesel margins will need to narrow compared to biodiesel margins to drive biodiesel capacity out of the market in order to accommodate the growth in renewable diesel production. Ultimately, that will still have to happen. I don't think that it happens in 2023. It may happen a little bit in 2024. We've got biodiesel production down in 2024, so we're assuming that it kind of starts to happen a little bit more in 2024. And then with the switch from the blender's tax credit to the Inflation Reduction Act credit, that will also have an impact on biodiesel margins, because a lot more biodiesel uses soybean oil exclusively, particularly integrated biodiesel. Now those guys aren't going anywhere. They're integrated. They've got the cheapest cost of feedstocks of anybody, and so even with the switch to the IRA, I don't think those guys are going anywhere. But you are going to need to rationalize biodiesel production. But I just wanted to follow up with this and kind of show you where I've landed and explain that I'm comfortable with this outlook. We'll see what happens over the next several weeks, and in the longer term, over the balance of 2023, what happens with energy prices and with the economy, and that probably will have a bigger impact on these margins than anything else. All right. With that, I've got one question. If anybody else has any questions, they can let me know. And this one's easy to answer. So roughly how much ethanol is exported? Ethanol exports are, and excuse me for looking off here for a second, but I can actually tell you this number. Ethanol exports are, sorry. And again, there's a relatively significant difference between what the or there can be a relatively significant difference between what EIA reports for ethanol exports and what the Census Bureau reports for ethanol exports. I don't know if one is better than the other. I don't know that I think one is better than the other. I think they're different. I tend to fall towards census for all things, mostly out of consistency's sake. We use the census for many other things, and so it makes sense to me to use the census for that. Ethanol exports, according to the census, over the last 5 marketing years have averaged about 1.4 billion gallons. And if you look at the total for, let's see, the total for 2022 was, the total for 2022 was 1.35 billion gallons. For 2021, it was 1.24 billion gallons. So it's relatively steady, or it has been relatively steady around that same level over the past 4 or 5 years. Before that, it was relatively low, but it has grown pretty dramatically. So if I look back to the 2009-10 marketing year, we exported 261 million gallons, and then just 2 years later we exported 1 billion gallons. So they've grown, but they seem to be settled into this range, sort of between, I would say, 1.2 and 1.5 or 1.6 billion gallons, somewhere in there. Going forward, our forecast essentially uses about 1.5 billion gallons a year of ethanol exports to account for the trend. I guess that's the number that we picked. If you're curious, we import about 250 million gallons of ethanol a year. That's fallen off a little bit actually in recent years, but again, we're using the 250 kind of going forward, except for 22-23, where a really slow start to the year means that we've got 150 million gallons of ethanol imports for the US. All right, with that, if there aren't any other questions, then I hope everybody has a wonderful week, and going forward, again, I should be on track to get back to my old actually producing reports, and so you won't wonder whether the data is updated or not. And I will see everybody next Tuesday. Thanks again for attending. See you next week.